What if the Social Security Administration had the power to look directly into your bank account at any time? What if every deposit, every transfer, every purchase could be reviewed against your benefits? Would you feel safe or would you worry about what that kind of access means for your future? This is not science fiction. This is the direction things are moving. Starting with a rule called EM25046, this emergency message is a sign of how the SSA plans to expand its reach. And today we are going to unpack exactly what it means, how artificial intelligence is being used to scan accounts, what types of transactions are most likely to draw attention, and what you can do to stay on the safe side. This is not meant to scare you, but to prepare you. Because the truth is, Social Security is evolving into something much more aggressive in how it monitors recipients. And if you depend on SSI, SSDI, or retirement benefits, you need to understand these changes so you can protect yourself and avoid unnecessary risks. So let's begin with the rule itself. EM 25046 was an internal emergency message. Its purpose was to tell managers and field offices to begin applying a new approach to bank account verification for people on supplemental security income. SSI is the most tightly controlled program under Social Security. Unlike retirement or disability insurance, which are based on work history, SSI is strictly for those with very low income and very limited resources. To qualify, you cannot have more than $2,000 in countable assets as an individual. Because of that rule, the SSA has always looked closely at bank accounts for SSI recipients, but EM 25046 went a step further. It essentially told managers that restrictions should be loosened so that bank account checks could be faster, broader, and more direct. In other words, the SSA wanted easier and quicker access to see what was going on with SSI recipients' money. Now, at first glance, this might sound like it only affects seniors over 65 who are on SSI, but if you read the language carefully, it hints at something bigger. The message described this as a starting point, suggesting that other groups like disabled SSI recipients, immigrants receiving SSI, and others would eventually be included. This matters because history shows us how small pilot programs expand over time. What begins as a limited rule often grows into a standard practice for millions of people. In this case, it could eventually touch SSDI beneficiaries and even retirees. The pattern is always the same. Start with a narrow group, test the system, work out the bugs, and then roll it out to everyone else. It happened with data matching programs in the past. It happened with online reporting requirements. And it will likely happen with this kind of enhanced bank monitoring as well. Why is the SSA pushing for this level of access? From their point of view, the reason is obvious. They are under constant pressure to reduce fraud and improper payments. Every year, billions of dollars go out in overpayments, sometimes because people fail to report income, sometimes because the agency made mistakes, and sometimes because of outright fraud. By having faster access to bank account information, the SSA can spot problems quickly. If someone's resources jump over the $2,000 SSI limit, they can flag it. If someone is working and doesn't report their wages, they can see deposits and match them with payroll data. The agency argues that this saves money and protects the trust fund. But for recipients, it means living under a microscope where even innocent mistakes can cause huge headaches. The balance between stopping fraud and respecting privacy is difficult to maintain, and right now the scale is tipping heavily toward surveillance. To understand how serious this is, look at real-world cases. In Pennsylvania, a man applied for SSI while working multiple jobs. He did not report his wages, assuming no one would notice, but payroll records and bank deposits told a different story. The SSA compared the information and concluded he should not have been receiving benefits. He was charged with fraud, ordered to repay overpayments, and now faces possible prison time. This is not a rare event. The agency has been publishing more and more of these cases as examples, and they want to send a message. If you try to hide income, you will eventually be caught. In another case from Texas, a woman received a small inheritance and deposited it into her account without reporting it to SSA. Within weeks, she received a notice that her SSI was being suspended because she exceeded the resource limit. She had no idea the money needed to be reported so quickly. These examples show that the system is faster and more thorough than it used to be. The reason they can catch these cases faster today is because of artificial intelligence. In the past, a human would have to review bank statements manually, which took time and resources. Now, AI-powered crawlers can scan thousands of accounts in minutes. These systems look for patterns, steady payroll deposits, regular transfers, or sudden lump sum spikes. They don't care about every cup of coffee or grocery purchase. What they care about are trends that suggest income, resources, or support that should have been reported. And once those patterns are flagged, a human investigator can step in to review the details. For recipients, this means the old idea of maybe they won't notice is no longer realistic. The systems are built to notice, they are designed to catch inconsistencies, and they work around the clock without getting tired or making excuses. Let's break down the types of transactions that are most likely to draw attention. First are employer payroll deposits. These are the easiest to spot, especially because many large payroll processors like ADP or Paychex already send data directly to government agencies. If you are working while receiving SSI, those wages must be reported. For SSDI, steady work above the substantial gainful activity threshold, currently just over $1,400 a month, can put your eligibility at risk. For retirees under full retirement age, earning too much can reduce your monthly checks through the earnings test. The bottom line is simple. If you are getting paid by an employer, the SSA will know. There is no hiding it. The data flows automatically from employer systems to government databases, and that connection is only getting stronger. Next are gig economy payments. Many people assume that income from Uber, DoorDash, Amazon Flex, or Upwork is somehow invisible because it comes from an app. That is simply not true. These companies issue 1099 forms to the IRS, and deposits show up clearly in bank accounts. For SSI, gig income reduces your benefits just like wages do. For SSDI, steady gig work can be treated as self-employment and compared to substantial gainful activity limits. The misconception that gig income doesn't count has led many people into trouble. Some believe that because they are not officially employed, the income does not need to be reported. That belief has cost people their benefits, led to overpayment demands, and in some cases resulted in fraud charges. Then we have peer-to-peer transfers, the Cash Apps, and Venmos of the world. If you occasionally send money to a friend or receive $20 back for pizza, that is not a problem. But if your son or daughter is regularly transferring you $300 every month, that can be considered support for SSI. This kind of support in food or shelter can trigger the 1/3 reduction rule, which means your monthly payment could drop. The key here is patterns. A one-off gift is different from ongoing help. If the transfers happen every month like clockwork, the system will see that as reliable income or support, and that changes how your benefit is calculated. Large lump sums are another red flag. Think about inheritances, legal settlements, or insurance payouts. If you are on SSI and suddenly receive $10,000, you will almost certainly be over the $2,000 resource limit. Sometimes exclusions apply, and sometimes you have a short window to spend down the money on approved expenses, but ignoring it is not an option. Documentation is crucial in these cases. You need to show where the money came from, what it was for, and how it was used. Without that paper trail, the SSA can make assumptions that work against you. Sales of property also stand out. Selling a house, car, land, or even cryptocurrency creates deposits that the systems can see. Collectibles are a little more complicated, but the principle is the same. If you're on SSI, proceeds from a sale may count as a resource unless excluded. If you are on SSDI or retirement, sales don't directly affect eligibility, but they can still influence taxes and draw scrutiny. Keeping bills of sale and clear records is essential. This applies whether you are selling a vehicle for $5,000 or liquidating a coin collection. The deposit will appear, and the SSA will want to know what it represents. Gambling and lottery winnings are closely watched as well. Even small winnings can matter if they push your account balance over resource limits. State lotteries and casinos report larger winnings to the IRS, and online gaming apps leave digital trails. Again, it's not just the $1 million jackpot. It could be smaller amounts that add up. If you win $500 at a casino and deposit it, that money counts toward your resources. And if it pushes you over the limit, your benefits could be affected. Tax refunds and stimulus checks can also be tricky. For SSI, a refund can temporarily raise your account balance. Some refunds are excluded for up to a year, but after that, they may count against your resource limit. This is why it is important to track the source of deposits and understand the time-limited protections that apply. Many people do not realize that even government payments, like tax refunds, can eventually become countable resources if they are not spent within the protected period. Rental income and Airbnb payments are treated as ongoing income flows. If you rent out a room or manage a short-term rental, the deposits are clear. These can reduce SSI benefits or raise questions for SSDI if the activity looks like substantial work. Similarly, self-employment and small business deposits are scrutinized. If you buy inventory, receive client payments, or have regular merchant deposits, SSA may compare your activity to IRS filings to see if your reported income matches reality. Discrepancies between what you told SSA and what the IRS shows can lead to investigations. International transfers are another area of concern. If money is frequently leaving the country, or if you are withdrawing funds abroad, SSA may ask whether you are still living in the U.S. SSI has strict residency rules. Extended absences can stop your benefits. Even for SSDI and retirement, overseas activity can raise questions about employment or living arrangements. This is especially relevant for people with family abroad or those who travel frequently. Installment payments from private sales are often misunderstood. Let's say you sell an RV and the buyer pays you $500 a month for 2 years. Those deposits will appear as a regular pattern. Without a contract to explain them, SSA could assume they are wages or ongoing support. Keeping the sales agreement and reporting it is the only safe way. The same applies to personal loans you may have made. If someone is paying you back over time, document it. Even household bill reimbursements can be important. If someone is paying your rent or food every month, that counts as in-kind support for SSI and can reduce your benefit. Covering a utility bill here and there is different, but patterns of consistent help matter. This is one of the most misunderstood areas of SSI. People think that help from family does not count as income, but under the rules, it absolutely does. Representative payee misuse is also monitored. If a payee is supposed to spend funds for a disabled person but instead uses the money for vacations or luxuries, spending patterns will reveal the abuse. The SSA tracks how representative payees use benefit funds, and when misuse is detected, the payee can be removed, charged, and required to repay the stolen funds. Although EM 25046 was focused on SSI, these monitoring tools are spreading. SSDI and retirement beneficiaries already face payroll matching and data checks. The technology is moving toward broader use, and within the next decade, it's likely that more direct account monitoring will become standard for everyone. This represents a cultural shift inside the SSA. The agency is moving from a traditional government-style operation to something more like a corporate watchdog. The more improper payments they stop, the more money they save, and in their eyes, every dollar saved is a dollar earned for the trust fund. For beneficiaries, this means more notices, more requests for verification, and quicker detection of problems. But it also means that when you report honestly and keep records, decisions can be made faster and more accurately. The best protection is to live as if transparency already exists. Report changes promptly, keep documentation, and ask questions if you are unsure. For SSI recipients, pay special attention to the $2,000 resource limit and the rules on in-kind support. For SSDI, learn the substantial gainful activity threshold and understand how trial work periods work. For retirees, know the earnings test if you are under full retirement age and be aware of how other income may affect taxes. These are not mysteries. They are rules you can learn and apply. And once you know them, you can manage your finances with confidence. So what does this all mean in plain terms? EM 25046 gave SSA a green light to expand bank monitoring for SSI, and it signaled that this oversight may grow in the future. AI crawlers are now sweeping accounts for patterns that could indicate unreported income, support, or resources. The list of transactions under watch includes payroll, gig income, peer-to-peer transfers, lump sums, sales, gambling, tax refunds, rental income, self-employment, international transfers, installment payments, and household support. The direction is clear. We are moving toward a future where transparency is assumed. Now, I want to hear from you. Do you think this kind of monitoring keeps the system fair? Or do you believe it goes too far and crosses into government overreach? Share your thoughts in the comments below because your voice matters and your perspective helps shape this conversation. If you found this breakdown helpful, please take a second to like the video. It tells me that this kind of deep dive into Social Security issues is valuable to you. And don't forget to subscribe to Social Security Post for ongoing updates about benefits, policy changes, and proposals that affect millions of Americans. Staying informed is the best way to stay protected.